All right, everybody, welcome back to Matt Money. We're going to be talking briefly about Palantir today. I'm going to be walking through a Seeking Alpha article, which I thought was quite interesting. If you guys don't know already, Palantir is one of my favorite companies that I invest in. I have over 3,300 shares of it, and it's going to be a company that I'm potentially holding for the long term. I think it's probably going to be one of my first, if not my first, $100,000 position when it eventually kind of turns around. So this isn't going to be something that I'm holding for a month, 2 months. This is going to be something I'm going to be holding for the long term, 10 years, potentially forever. I honestly think that going into the 2030s, especially with some of the trends and stuff that you're going to see today, you guys might be fully enticed to take a quick look at it as well. And I think more and more analysts are warming up to the stock as well, considering the massive price decrease that it's had over the past few years since it went direct listing back in September of 2020. I bought my first 1,000 shares back in September 2020, and I've been consistently adding ever since with approximately $13 cost basis. So I'm down, a decent bit. But at the end of the day, like I said, is a company I have strong conviction in, coupled with Rocket Lab, that I think will be phenomenal companies for the long term. So I wanted to share this company specifically with you guys, and hopefully you guys see some good value in it as well. So I'm just pulling up an article here on Seeking Alpha. I did just get Seeking Alpha Premium. I think it's a pretty cool tool. So if you guys are interested in checking out Seeking Alpha Premium, feel free to check out the link in the description below. But this is more specifically talking about Palantir. Victor Durganov wrote a good article today, published it about 2 or 3 hours ago, talking about specifically Palantir being one of the worst hit stocks in growth over the past year, which I agree with. And a lot of people are really hating on the stock due to the share-based compensation, or SBC for short. Lack of profitability, high valuations, all that stuff, which I can understand in the short term. And lack of profitability, if you to take into the share-based compensation, which is kind of creating money out of thin air, yes, it ends up being unprofitable, but it is free cash flow positive, if that makes any sense. When you do the share-based compensation, it hits your bottom line, so you do have to take those earnings somewhere. But at the end of the day, based off the company's cash that they take in from operations, based off of their CapEx and everything the like, at the end of the day, they end up with more money than they lose. It's just more so based off the share-based compensation that hits the earnings pretty extensively. So a lot of people dislike the fact that this company is an $18 billion company trading for 10 times sales. You can see the massive price decline over the past year or so, peaking out at the $29, $30 range, and now it's sitting below $10 with the 200-day moving average sitting at just under $15 here. My cost base is sitting around this $13 marker. So I've been purchasing this entire time. I think I spent about a year and a half only holding about 1,000 shares. And after this more recent decline, I continue to buy, part of that through cash secured puts and other parts is buying on the open market. So I am a holder. So I just want to disclose that to everybody. What I do want to talk a little bit about, a lot of people dislike the share-based compensation piece, which is in this article, but a little bit about Palantir being the favorite contractor, which I agree with. It mostly started off as, and it actually did start off as, in the early 2000s, as a government entity, not entity rather, but an entity created to help the government rather be able to meet and solve their problems. And so it's developed into a huge client base for the government, being the military, intelligence and police, FBI, DOD, CIA, NSA, and I think they also do some of the CV stuff that they've done for the CDC and other healthcare departments in the UK and also other places as well. Palantir also helps the NHS, FDA, other agencies, and it's growing its corporate business as well, which I actually use on a personal basis day to day at work. Still derives the majority of its revenues, 54% of which being from government contracts as of last quarter, and it ends up getting a large portion of that, which is rather steady, from the government. And looking at specifically some of these numbers, which I really like to look at, commercial revenue itself grew 54% year over year. Government revenue grew 16% year over year, but the total customer count, which I think is important, grew 86%. I don't think it says it on here, but one of the key things that I like to look at is the net retention rate that, or maybe it's TRR, total retention rate, one or the other, that basically says, hey, in terms of the value that we get from these new customers that we're acquiring, it's over 100%. So not only are they retaining customers, but they're also growing the revenue that they get from those customers rather substantially. One of the things that I also want to highlight is the 136% year-over-year U.S. commercial revenue growth. So commercial growth on its own is 54%, but U.S. specific was 136%, and the 86% year-over-year customer growth, which I kind of mentioned a little bit earlier. So a lot of people are kind of upset with Alex Karp and his, I guess, bluntness towards shareholders. And basically, he's building a company for the long term. So he says, if you're looking for next year profits or the year after profits, maybe Palantir is not right for you. But if you're looking for the next 5, 10, 20 years, a company that's trying to build something for the long term, we might be the company for you. So when they gave a guidance report in 2021 of approximately 30% annualized revenue growth, that was kind of where they were saying, and they're not going to try to give year-over-year sort of values, and try to overbeat themselves or anything like that to hit some random number that the shareholders or the institutional investors might want them to hit. They just say, we anticipate growing 30% year over year. So when the company kind of came out with an operating margin of approximately 27% and a 30% annual revenue growth, that was well received by somebody like myself, but for people that I guess are looking for 100% year-over-year revenue growth from a company that is really just starting to kick off their sales team, people might be rather upset. But I do agree that just looking at this wholly, if you were to see the revenue grow rather substantially year-over-year, going from $341 million in the first quarter of 2021 to $446 million in the first quarter of 2022, you can see the gross profit also grew from 267 to 351 million, which is pretty substantial. And when you think about it and look at it, the only real reason as to why they weren't profitable was more so based off the share-based compensation piece. And if you kind of eliminate that, they did end up being partly profitable. Gross profit increased by 32% year over year, kind of just displayed that. Operating expenses only grew by 2.6%. So if you're continuing to increase your customer base, your revenue streams, and increase the total amount of revenue coming through the door, your gross profit is going to continue to grow, and your operating expenses are going to stay rather low. Operating loss last quarter is much more narrow than last year's quarter, 39.4 million versus 114 million a year ago. Gross margins came in at about 78.6%, which is pretty good. And I think their target's about 80 to 85% for gross margin, which is phenomenal. And therefore, from here on out, any additional contracts that they kind of bring on are going to be extremely profitable, especially if they're able to kind of keep those operating expenditures down. What else was there? So dilution, a lot of people were highlighting 1Q over 1Q that the share dilution was about 11% year over year. So they were pretty upset about Palantir diluting shares. But Palantir only went public with 476 million shares, and they have about 2 billion shares outstanding now, which basically was just the floating of not all the shares on day one, but rather allowing some of those shares to come public over time. And with that, let's just see, what else is there specifically for this? Share-based compensation is down about 23% year over year. Implies lower base expenses should continue going forward. But one of the key things is, hey, if you want to retain higher people or more people, you have to give them an opportunity to stay with the company and run with the company. So they gave out $193 million worth of shares in Q1 of 2021 and only $149 million in Q2 or Q1 of 2022. one of the things that they did say specifically, which I think is good, is the fact that on a operating basis, the gross profit is pretty good. So they're not, from a gross profits perspective, they're not losing money. Where they're only really losing money is this expense of, say, $150 or so million a quarter in share-based compensation, which ends up adding up, right? If you think about it. So that being said, if there is some sort of recession, you're going to still have great gross profitability. The only issues you're going to really have is with the share-based compensation. So just looking specifically at revenue and the growth. So this individual put an estimate of about 30% year over year out to 2025, which is what forecasted by Alex Karp himself. And so it kind of gives you an idea as to how the share price might grow with those revenues and the estimated kind of forward multiple. So what they're basically talking about is a forward price multiple, price to sales multiple of about 7. And so if you kind of keep that, or maybe even grow it through time as people become more, acceptable or accepting of Palantir and where it's kind of heading, that multiple might expand a little bit. What you're kind of seeing is an increase over the next several years to about a $7 billion revenue stream, which at 85% or 80% gross margin ends up being, pretty good, over $5 billion worth of gross margin. And if you're kind of being able to keep that similar sort of cost structure where you're really slowly increasing the overall costs of the business and operating the business, then you're probably going to walk away with something like $2 to $3 billion worth of cash from that value here. And I'm just kind of picking numbers out of the air, but you're kind of getting an idea as to what I'm saying. Costs are not going up nearly as fast as, say, the revenue is. And so if that's the case, you're going to continue to increase profitability of the entire company going forward. So utilizing the 30% growth rate and drop off in 2027 gets you about $7.3 billion in 2027 of revenue. So it's pretty cool, and about the same of like an NVIDIA or a Microsoft based off what this company says. So I'm pretty bullish on this, and I just want to talk a little bit about what this author says the risks to Palantir are. He's bullish as well. Could consider several potential risks associated with the investment. Growth story is strong, but shares are not treated by traditional metrics, which I agree with. Near-term share price is high compared to what you're looking at and the earnings that it currently has. But earnings are still minimal, may not increase as much as they envision, meaning the company, as well as I guess we envision. I'm cautiously optimistic that the company will beat the 30% year-over-year revenue growth over the next 2 to 3 years, just based off of some of the recent partnerships that I've seen come down the pipeline and knowing that they'll grow over time with my own experience in the company I work with by myself, not specifically us growing, but just knowing how good of a product is, how good their product is, and how you can continue to expand the use of Palantir's products year over year. Palantir lost favor with the government for any reason, such as data breach or anything like that. Could lose confidence unless people would potentially want to use Palantir, and especially lose the favoritism of the government, which is currently at a 50% revenue at the moment. So, like I said, hope you guys enjoyed this one. Like I said, share it with a grain of salt, or think about it with a grain of salt, because I do have 3,300 shares, but love the company. I'm going to continue to be a holder of it unless it increases in price drastically or something drastically changes with the underlying company. I'm going to be a holder. I'm just going to follow this guy really quick. So if you guys have any questions, comments, leave them down in the comment section down below. I'm more than happy to hear about anything you guys might want to talk about. Do not forget the Seeking Alpha link in the description down below if you guys are interested. And I will see you guys on the next video. Cheers.